Hello and welcome back to the Deep Dive. It is Friday, February 13th, 2026.
Friday the 13th. That feels appropriate for what we're about to talk about.
I know, right? If that date feels a little ominous to you, it might be because we are officially in the season where the new tax rules really start to bite. You look at the calendar, you look at your pay stub, and suddenly you realize the game has changed.
That is right. It is Friday the 13th, and we are talking about the Internal Revenue Service. I honestly think that is the most fitting combination we have ever had on the show.
It really is. It's perfect. But look, today we are doing something a little different.
Yeah.
Usually around this time of year, we do a quick update. We say, hey, inflation happened. The 401k limit went up by $500. Congratulations. Go buy a latte. We all clap and we move on.
Right. Usually it is a total snooze fest. It's a footnote in the grand scheme of things. Limits are up. Save more. The end.
Exactly.
Huh.
But this year, 2026.
Yeah.
This year feels different. I mean, we have been reading through a massive stack of documents to prep for this.
Oh, yeah. My desk is covered.
We've got government releases from the IRS, some really dense legal analysis from a firm called J.D. Supra.
Which was fascinating.
In a terrifying way, yeah.
Yeah.
And then some really biting academic critiques from places like the Urban Institute and the Center for Retirement Research at Boston College.
And those were not pulling any punches.
Not at all. And on top of all that, we have a whole host of financial advice and, data from places like Moneyzine, UBS, NerdWallet, and SmartAsset.
Right.
And the consensus seems to be that the rules of the game they've fundamentally changed.
Absolutely. This isn't just about inflation adjustments anymore. It isn't just about the simple advice to save more money. It is about where you put it.
Right.
And, there is a lot of legislative sleight of hand happening here. The government is changing the incentives in a way that I don't think most people have fully grasped yet.
Legislative sleight of hand. I love that phrase. It sounds so nefarious.
Well, I wouldn't go so far as to say nefarious necessarily, but it is clever. Let's call it clever. And if you aren't paying attention, that cleverness is going to cost you money, a lot of money.
So our mission today is to move beyond that standard, save 10% of your income advice. We're going to unpack the math behind the whole Roth versus traditional debate.
The great debate.
The great debate. And honestly, based on the research we have done for this deep dive, the common wisdom, it's the stuff you see on TikTok or reading generic finance blogs, might be costing our listeners hundreds of thousands of dollars over their lifetime.
And it sounds hyperbolic when you say hundreds of thousands, but when you actually run the numbers, when you look at compound interest and tax drag over 30 or 40 years, the math backs it up. It's startling. It really is.
So let's dive in. We have to start with the landscape. Section 1, the 2026 numbers game. What are we actually looking at for this tax year?
Okay, let's start with the good news, or at least the headline news. The base contribution limit for employees has gone up. For 2026, you can now sock away $24,500 into your 401k. That is up from $23,500 back in 2025.
Okay, so a $1,000 bump. That tracks with inflation, more or less. I mean, $24,500 is a lot of money to be able to shield from taxes in a single year.
It is. It's a significant amount. If you are in a high tax bracket, say 32% federal plus whatever your state taxes are, shielding an extra grand or shielding that full 24.5 saves you a tremendous amount of cash flow today.
For sure.
But where it gets really interesting and, where the complexity starts to creep in is the catch-up contributions.
Right, the catch-up. This is for the older crowd, although I hesitate to call 50 old.
Well, in the eyes of the IRS, 50 is the magic number. It's when you suddenly get these extra privileges. So if you are age 50 or older, your standard catch-up contribution is now $8,000.
$8,000. So that's on top of the 24.5.
On top of it. So if you're a 50 plus, your total potential contribution, the base plus the catch-up, is $32,500.
Okay, that is substantial. I mean, that's more than some people earn in a year. Being able to save that much tax deferred is a huge benefit.
It's a massive advantage. But I was reading the IRS notice and our prep notes, and there's this very specific, almost weirdly specific group of people who get an even bigger break.
Yes.
It felt like I was reading a cheat code for a video game.
That's a perfect way to put it. It's like you found a hidden level.
Yes, the special patch-up. This is a direct result of the Secure 2.0 Act, which was passed a few years ago, but is, fully kicking in now.
Okay, so who gets this cheat code?
If you are specifically aged 60, 61, 62, or 63, your catch-up limit isn't that standard $8,000. It is significantly higher. It's $11,250.
Wait, pause on that. Just those 4 years?
Yeah.
60, 61, 62, and 63.
Just those 4 years. It's this tiny little window.
So if I'm 59, I'm out of luck. If I'm 64, I'm out of luck.
Correct. Once you hit 64, you drop back down to the standard catch-up. But for that specific 4-year window, thanks to Secure 2.0, you can put away the base of $24,500 plus the special $11,250 catch-up.
Wow. So what's that total?
That is a total of $35,750 in a single year.
$35,750. That is a massive amount of money to shield from taxes in a single year.
A huge sum.
So why that specific window? Why 60 to 63? Is there some logic to it?
I think there is. Think about the life cycle of a saver. By age 60, you are staring retirement directly in the face. It's not some abstract concept anymore.
Right, it's right around the corner.
Maybe you realize you are a little behind. Maybe the kids are finally off the payroll. College is paid for.
The mortgage might be gone.
The mortgage might be gone. This is your peak earning years and your peak saving years.
Yeah.
It's the sprint to the finish. The government is basically giving you a Super Mario star for 4 years to run as fast as you can toward that retirement finish line.
It feels like they are trying to help people make up for lost time right before they file for Social Security or start their pensions.
That is exactly the idea. But, and here is where the sleight of hand we talked about comes in. There is a trap. We call it the high earner trap. And this is where that Friday the 13th bad luck comes into play.
I saw this in the JD Super analysis and I had to read it twice because it seemed remarkably inconvenient. It's one of those things that's buried in the details.
It is.
Walk us through this because this is where people are going to get tripped up.
So historically, going back decades, you could always choose where your catch-up contributions went.
Me too.
You could put them in your pre-tax traditional 401k to lower your tax bill today, or you could put them in a Roth if you wanted. It was your choice. Freedom of choice was the default.
Right. You assess your own tax situation, you look at your income, you make a call. Simple.
Not anymore. Starting in 2026, there is a new rule. If you earn more than $145,000 in the prior year, so that would be your 2025 wages, you are no longer allowed to make catch-up contributions on a pre-tax basis.
Whoa. Let's stop there. $145,000. That's the line in the sand.
That is the threshold. And it's indexed to inflation, so it'll creep up. But for now, that's the number. And notice it says prior year wages. So your payroll department, your company software, has to look at what they paid you in 2025.
That's a key detail. It's not what you're earning this year.
No, it's retrospective. So if that box on your W-2 from last year says $145,001, you are triggered by this rule.
So if I made $146,000 last year and I want to put in that extra $8,000 catch-up because I'm 55 years old, the government is forcing me to put it in a Roth.
Correct. You must use the Roth bucket for that catch-up portion. Your base contribution, that $24,500, you can still put that in traditional. But the catch-up, that $8,000, has to be Roth.
And just so we are crystal clear for the listener, what does that actually mean for their paycheck, for their tax bill this year?
The implication is huge. It means you pay taxes on that money now. You cannot defer it.
Okay, give me an example.
All right. Let's say you're in the 24% marginal tax bracket. If you put $8,000 into a traditional account, your taxable income for the year is $8,000 lower. You save 24% of $8,000, which is what? $1,920 in federal tax you don't have to pay this year?
Almost $2,000 in your pocket.
Exactly. But now you're forced to put it into a Roth. That $8,000 is still part of your taxable income. You don't get the deduction. So you owe that extra $1,920 in taxes this year that you wouldn't have owed under the old rules.
Okay, let's unpack this. Why would they do that? I thought the whole point of these accounts, the government's goal, was to encourage us to save for retirement. Forcing us to pay taxes on it now feels counterintuitive if the goal is to encourage savings.
Well, if we connect this to the bigger picture, it is not an accidental policy. It is a very calculated revenue grab.
Wow.
You have to understand how Congress scores these bills. The government, specifically the Congressional Budget Office, operates on 10-year budget windows.
The budget window. I've heard this before. Everything is about making the numbers look good inside that 10-year frame.
Right. If you put money in a traditional 401k, the government doesn't see a dime of tax revenue for maybe 10, 20, or 30 years until you retire. From a CBO scoring perspective, that's a revenue loss today. It doesn't help the current budget deficit.
But if they force you into a Roth,
They collect that income tax revenue immediately. It shows up as revenue on this year's books.
so they are trading future revenue for current revenue.
Yeah.
They want the cash now to make the deficit look slightly better on paper.
Exactly. They are pulling tax revenue forward. They are effectively borrowing from their future selves. And for the saver, it removes a key tool for managing your current tax bracket. You lose that deduction right at the moment you might be earning the most money in your entire career.
And there was a warning in that J.D. Super article about the operational headache here. It wasn't just about the saver's choice. It sounded like a bit of a crisis for the plans themselves.
It is a massive headache, a huge one. We call it the plan design crisis.
Why is it a crisis? Can't they just flip a switch in the software? Add a Roth option.
You would think so. But the warning from JD Supra was stark. If your company's plan doesn't offer a Roth option, and believe it or not, many smaller plans or older legacy plans still don't. High earners might be completely locked out of catch-up contributions.
Wait, explain that logic. How does not having a Roth option block you entirely?
It's a paradox. The law says if you make over 145K, your catch-up must be Roth. But if the plan document, the legal paperwork for the 401K, says we do not offer a Roth account, then you have an error. The system can't comply.
So there's nowhere for the money to go.
Exactly. You cannot make the contribution because there is no legally permissible bucket to put it in. The traditional bucket is illegal for you, and the Roth bucket doesn't exist.
Wow. So it's not just an inconvenience. It could actually stop you from saving that extra money if your HR department hasn't updated the plan documents and gotten all the paperwork in order.
Precisely. You could go to your online portal, try to elect your $8,000 catch-up, and the system will simply reject it. It'll throw an error.
So what's the advice here?
If you are a high earner, you need to be checking with your benefits administrator right now. Like this week. Don't assume it's working. Ask them the specific question. Are we compliant with the mandatory Roth catch-up rule for high wage earners under Secure 2.0?
That is wild. I can just imagine a lot of very angry emails to HR departments this month from people realizing they can't save as much as they thought.
It's going to be a mess for a lot of companies that weren't on top of this.
Okay, so that is the catch-up contribution, a minefield. But there's another change that affects employer matching, right? This is the employer match revolution section of our notes.
This is another feature of Secure 2.0, and again, on the surface, it sounds like a gift, but you have to look closely at the fine print.
There's always fine print.
Always. Traditionally, the old way was simple. Even if you, the employee, put your money into a Roth 401k, the employer match had to go into the pre-tax traditional bucket. The government required that separation.
Right, I remember that. You'd look at your statement and have this split account. Your money was in the Roth bucket, growing tax-free, but the employer's money was in the traditional bucket, which is taxable later.
Exactly. It was a strict wall between your contributions and their match. But the new way, effective now, allows employers to offer to put the matching contribution into the Roth bucket as well. It's an option for them.
On the surface, that sounds amazing. I mean, who doesn't want their employer's free money to grow tax-free forever? That sounds like the holy grail of retirement saving.
It does sound great. It sounds like a fantastic new benefit. But there is a catch, as always.
Yes, there is.
If you choose this option, if you elect to have your match go into the Roth, that employer match counts as taxable income for you today.
Ah, I see. So it's not really free from a tax perspective in the current year.
Not at all. So if your boss gives you a $5,000 match and puts it in the Roth, that $5,000 is added to your W-2 income. You have to pay federal, state, and maybe even local taxes on that $5,000 when you file your return this year.
So it's essentially treated like a cash bonus that your company immediately forces you to invest. You never see the cash, but you still owe the tax on it.
That's the perfect analogy. So come April, you might have a nasty surprise. You thought you had your withholdings all figured out, and then you realize you owe another $1,000 or $2,000 in taxes because of this free money from your boss.
And there was another nuance Smart Asset pointed out that I think is fascinating, specifically for people who change jobs a lot.
Yes. This is a really interesting little quirk of the law. These Roth matching contributions must be fully vested immediately.
Okay, let's explain vesting for the listeners who might be new to corporate benefits.
Sure. Vesting is basically the golden handcuffs.
Yeah.
Usually when a company matches your 401k, that money isn't really yours yet. It vests over time. Maybe it's a 3-year cliff where you get 100% after 3 years, or a graded schedule where you get 20% a year for 5 years.
Right. And if you quit before, you're fully vested.
You walk away from some or all of that match. The company takes the rest back. It's a retention tool. It keeps you in the seat.
Okay, so why does a Roth match have to be immediately vested?
It's a logic puzzle, really. If the company puts the match in a Roth, that means you paid taxes on it, right?
Right.
The IRS does not want a situation where you pay tax on $5,000 and then you quit your job, the company takes money back, and now the IRS has to figure out how to refund you that tax. It's an administrative nightmare for them.
So to avoid that.
To avoid that, the law says, if it is a Roth match, it must be 100% vested immediately. It has to be yours irrevocably the moment it hits the account.
That is a fascinating loophole. So if you are a job hopper or you know you are going to leave your company in 6 months, you might actually want to pay the tax on the match just to guarantee you keep the money.
Exactly. You are paying the tax as an insurance policy to bypass the vesting schedule. It's a strategic play.
Yeah.
If your company has a 5-year vesting schedule and you know you're leaving after 2, you could elect the Roth match, pay the tax for 2 years, and walk away with 100% of the match instead of just 40%.
That is really clever. It seems like the theme of 2026 is pay taxes now. The government is creating all these different pathways to get you to settle your tax bill up front.
That is definitely the theme. The government is incentivizing, or in some cases, as we saw with the ketchup, mandating that you pay up now. They are hungry for revenue.
Which brings us to the core of our deep dive today, the big one. The traditional versus Roth debate. I feel like this is the Coke versus Pepsi of the personal finance world.
It is.
Everyone has an opinion, and people feel very, very strongly about it.
They do. And most people, I find, rely on what we call conventional wisdom. You see it everywhere online, in magazines, you hear it from friends.
Right, so let's define terms quickly just to make sure we are all on the same page. Traditional means you get a tax deduction now, but you pay taxes when you withdraw the money. It's instant gratification on the tax break.
Correct. You push the tax bill into the future, you kick the can down the road. And Roth is delayed gratification. You pay the tax now, you get no deduction today, but the money grows tax-free, and you pay 0 taxes when you withdraw it in retirement.
Okay. And the standard heuristic, the rule of thumb you read in every basic finance blog, is pretty simple. It says, if you think your taxes will be higher in retirement, choose Roth.
And if you think your taxes will be lower in retirement, choose traditional.
On the surface, that makes perfect logical sense. It's a pure arbitrage play. You want to pay taxes when the rate is lowest. If you pay 22% now to avoid paying 30% later, you win. Simple.
It seems simple, but the sources we looked at, specifically the analysis from UBS and John Hancock, point out a pretty big flaw in that logic.
What's the flaw?
The flaw is the unknown variable. How on earth can you predict tax rates 30 years from now?
Exactly. I mean, predicting the stock market for the next 30 days is hard enough. Predicting congressional tax policy in the year 2056 seems impossible. I don't even know who the president will be in 2028, let alone the tax code in 2056.
It is impossible. And because of that fear, the fear that taxes have nowhere to go but up, many people default to the Roth. It feels like the safer bet.
I can see that. You look at the national debt, you look at the deficit, you hear politicians talking about new programs, and you assume taxes must skyrocket.
Right. So Roth becomes the safe choice. It's the I don't trust the government choice.
Yeah.
You're basically buying tax insurance.
Plus, there is a psychological win, isn't there? I mean, looking at your 401k statement that says $1 million and knowing that is all mine, I don't have to share a single penny of that with the IRS, that feels really, really good.
It does. There is a distinct comfort in that. We can't discount the psychology of it. Certainty is a powerful emotional driver. But, and here's where we get into the contrarian deep dive, that psychological comfort might be incredibly expensive.
This is the part of the research that really blew my mind. We looked at a survey from Moneyzine. Tell us about the 91% mistake.
This was a fascinating data point. Moneyzine surveyed a large group of retirement savers and found that 92% of them thought they should be investing in a Roth.
The vast majority.
Almost everyone. They bought into the conventional wisdom. They thought taxes are historically low now, they will be high later, therefore Roth is the obvious winner.
92%. That is an overwhelming consensus.
It is. But when Moneyzine actually ran the math based on their individual age, their current income, and their expected spending in retirement, they found that only 9% of those people actually benefited mathematically from being in the Roth.
Wait, pause. Let that sink in. 92% thought they should do it, but only 9% actually should have.
That's right.
That is a massive disconnect. That means over 80% of people are actively making a decision that will likely leave them with less money in retirement. They're betting on the wrong horse.
It is a huge gap between perception and reality. And the reason for that gap, the reason so many people get this wrong, comes down to one key concept that is widely misunderstood: marginal versus effective tax rates.
Okay, let's unpack this, because I'll be honest, my eyes usually glaze over when I hear marginal and effective, but this is the technical heart of the argument. We need to make this crystal clear.
We do. This is the moment where we save the listener a fortune. Let's do a role play. Let's imagine a saver named Sarah.
Okay, Sarah, let's talk about Sarah.
Sarah is doing well. She earns $150,000 a year as a single filer. In 2026, with the current tax brackets, that puts her top dollars, her last earned dollars, in the 24% tax bracket.
Okay, so if she earns one more dollar from a bonus or a raise, the federal government takes 24 cents of it.
Exactly. That is her marginal rate, the rate on her next dollar. Now, let's say Sarah decides to put $10,000 into a traditional 401k. Because that contribution comes off the top of her income, she saves tax at her highest rate.
So she gets a 24% discount on that 10 grand. She saves $2,400 in taxes right now this year. The government effectively hands her $2,400 for making that contribution.
Correct. She is shielding money at her highest possible rate. That is the power of the traditional contribution. Now, let's fast forward 30 years. Sarah's retired. She's 65. She needs to buy groceries, pay for a trip to see her grandkids, whatever. She goes to her traditional 401k to withdraw that $10,000.
And the government, who has been waiting patiently for 30 years, says, pay up.
They do. But, and this is the absolute critical part of the entire debate, does the government tax that full $10,000 at 24%?
My gut says yes. It was 24% money when she put it in, so it should be 24% money when it comes out.
Yeah.
That seems fair.
And that is the mistake. That is the fallacy almost everyone falls for. When Sarah pulls money out in retirement, it's not top of the stack money anymore. For that year, it is her only income. And our tax system is progressive. It flows into the tax buckets from the bottom up.
I like the bucket visual. Explain that. What are the buckets?
Okay, imagine a series of buckets on the floor. The first and biggest bucket is the standard deduction. In 2026 numbers, that's roughly the first $15,000 of income for a single person. So Sarah pulls out her first $15,000 from her 401k. The tax on that is 0%.
Zero. I like that rate. Everyone likes that rate.
It's the best rate. So the first chunk of her retirement income is tax-free. Then she needs more money, so she pulls more out. It fills the next bucket. That's the 10% bracket. Then the 12% bracket. She has to pull out a significant amount of money, over $100,000 in today's dollars, before she even touches the 22% or 24% bracket again.
So even if she pulls out, say, $120,000 in a year to live on, and her last dollar is taxed at 24%, all that money underneath it was taxed at 0%, 10%, and 12%.
Exactly. Her total tax bill isn't $120,000 times 24%. It gets blended. So even if her marginal rate in retirement hits 24%, her effective tax rate, the average percentage she actually pays on her total withdrawal, might only be 12% or 14%.
This is the aha moment. Because if she does a Roth today, back when she's working, she is choosing to pay 24% tax now.
To avoid paying an effective rate of 12% or 14% later, she is voluntarily paying a premium of 10% or more just for the privilege of having a Roth. She's buying high and selling low, but with taxes.
Ouch. Put it that way, it sounds like a terrible deal.
Yeah.
You are locking in a guaranteed 24% loss on that tax arbitrage, essentially, compared to the alternative.
Precisely. And this is the core of the math. For the Roth to win mathematically, your effective tax rate in retirement needs to be higher than your marginal tax rate today. And for most people, that is incredibly rare.
Why is it so rare? What would have to happen for that to be true?
Well, a few things. You would need to have massive amounts of other taxable income in retirement that fills up those bottom buckets first. Like maybe you have a huge pension from a government job or huge rental income from a real estate portfolio. If that other income already fills up the 0%, 10%, and 12% buckets before you even touch your 401k, then your first 401k dollar comes out at a higher rate.
Okay, so if you have other income sources, the math can change.
It can. Or, as you said, tax rates would have to skyrocket.
Right. And that is the rebuttal we always hear.
Yeah.
But tax rates will go up. The national debt is high. Taxes have to rise. It's inevitable. It's a fair point. We are at historically low tax rates right now compared to, say, the 1970s.
We are. But Moneyzine ran the numbers on this, too, they asked. How much would tax brackets have to rise for the Roth to actually beat the traditional in a standard middle to high income scenario like Sarah's?
What was the number? What's the break-even point?
83%.
83%. Seriously.
Tax brackets across the board would need to increase by about 83%. So the 10% bracket would have to become an 18% bracket. The 12% bracket would be 22%. The 22% bracket would have to jump to nearly 40%. The increases would have to be draconian.
Wow.
So even if tax rates go up, the progression through the lower bracket, that gravity that pulls your average rate down, usually keeps the traditional 401k ahead.
That is staggering. It really shows how powerful that progressive tax structure is. It's a built-in buffer against tax hikes for retirees.
It is the gravity of the tax code. It pulls your average rate down, protecting you.
There was another point NerdWallet and Moneyzine made about something called opportunity cost. This is the idea that $10,000 in a traditional account doesn't cost the same out-of-pocket as $10,000 in a Roth.
This is crucial for the real-world math, for your actual take-home pay. If you contribute $10,000 to a traditional 401k, your paycheck only goes down by $10,000 minus the tax saving.
Right. Using our Sarah example, she saved $2,400 in taxes.
So that $10,000 contribution only feels like $7,600 coming out of her pocket. Her take-home pay is only reduced by that much.
Okay, it hurts less.
It hurts a lot less. But to put $10,000 in a Roth, she has to actually earn roughly $13,150, pay the 24% tax on that, which is $3,150, to be left with the $10,000 to invest. It is a much more expensive contribution in terms of current cash flow and labor.
So a Roth contribution is inherently more expensive to your current self.
It is. And the argument goes, if you took the tax savings from the traditional contribution, that extra $2,400, and invested that as well, say in a regular taxable brokerage account, the traditional strategy usually wins by a landslide.
Because you have more capital working for you sooner.
Exactly. You end up with two accounts, a large traditional 401k and a smaller brokerage account that combined are almost always worth more after tax than the single Roth account.
Right. But that's the big asterisk. If you invest the difference, that is always the kicker.
That is the behavioral caveat. You have to actually be disciplined and invest the tax savings. If you take that $2,400 tax saving and you buy a new 85-inch TV or go on vacation, the math changes completely. But assuming you are a disciplined saver, the traditional account allows you to build a larger nest egg faster.
Okay, so for the vast majority of people, the 91%, according to Moneyzine, the traditional pre-tax 401k, is the mathematically superior choice because of this marginal versus effective rate dynamic. That seems pretty settled based on the data.
It does.
But the Roth isn't useless. We know wealthy people love it. There has to be a reason. What are we missing?
Oh, absolutely. The Roth is an incredibly powerful tool, but it's a tool for a different job. We call this Section 5 the Super Roth.
Why do the wealthy love it if the math on tax rates doesn't work out for them either? Are they just bad at math?
Yeah. No, they are very, very good at math. But for the wealthy, it is not about tax rates. It is not about saving for their own retirement because they're already set.
Yeah.
It is about control and estate planning.
The Center for Retirement Research highlighted a major change in Secure 2.0 regarding RMDs. What happened there?
RMDs are required minimum distributions. With a traditional 401k or IRA, when you hit a certain age, it used to be 70 and a half, now it's climbing towards 75, the government forces you to take money out.
They come knocking. Time's up. Pay us.
Exactly. The government says, we waited patiently for 30 or 40 years for our tax revenue on this money. We want it now. They force you to withdraw a certain percentage each year and pay tax on it, whether you need the money or not. For wealthy people who don't need the cash to live on, this is just annoying.
It artificially inflates their taxable income and can push them into higher brackets or trigger other taxes.
Right, but Secure 2.0 eliminated RMDs for Roth 401k. Previously, Roth 401k had RMDs, which was a weird quirk of the law that made no sense. Now they don't, just like a Roth IRA.
So you never have to touch it. You can just let it sit there.
You never have to touch it. You can let that money compound completely tax-free until the day you die.
And that turns it from a retirement account into, what, an inheritance vehicle.
Exactly. It becomes a massive estate planning tool. It's basically a tax-free trust fund you can pass on. You can name your children or grandchildren as beneficiaries, and they inherit a pot of money that continues to grow and can be withdrawn completely tax-free.
And didn't the rules on inheriting IRAs change too a few years ago? The stretch IRA is dead, right?
It is. That's a critical piece of this puzzle. It used to be that if you inherited an IRA, you could stretch the distributions out over your lifetime. The government killed that. Now, most non-spouse heirs have to drain the entire account within 10 years of your death.
Oof.
So imagine you inherit a $2 million traditional IRA. You have to drain it in 10 years. That adds $200,000 to your taxable income every single year, likely pushing you into the highest tax brackets of your life. It's a tax bomb.
So the Roth avoids that tax bomb for your kids.
Exactly. If you inherit a Roth, you still have to drain it in 10 years, but all the withdrawals are tax-free. So for the wealthy, paying the tax now, even at a high marginal rate of 37%, is a gift to their children. It's about intergenerational wealth transfer, not retirement income for themselves.
That explains the Urban Institute's critique, then. They had a paper that called the Roth 401k bad public policy.
They did. They argue it's terrible for the country's finances. It reduces long-term national saving and mortgages future government revenue. Remember, every dollar that goes into a Roth today is a dollar the government can never tax again in the future.
And they had a specific calculation, right?
They did. The Urban Institute calculated that the government is essentially trading $1 of future tax revenue for roughly 20 cents of tax revenue today.
That sounds like a payday loan for the government. Give me 20 cents now and I'll forgive a dollar's worth of debt later.
That is exactly what it is. It helps the current 10-year budget window look better, but it creates a massive deficit hole in 20 or 30 years. From a public policy perspective, it's a bad deal for the Treasury, but it's a great deal for the wealthy saver who wants to leave a tax-free legacy.
So let's try to synthesize all of this for the listener. Who is the Roth actually for? We established it's not for the 91% who just want the best mathematical return for their own retirement. Who is in that special 9%?
Based on the profiles we have built from all these sources, there are really three distinct groups. And I'd say if you aren't in one of these groups, you should probably be putting your money in a traditional account.
Okay, lay them out for us. Group 1.
The young and early career.
This makes sense. If you were 22 years old, fresh out of college, maybe making $40,000 or $50,000 a year.
Your tax rate is almost zero. You're in the 10% or 12% bracket. Your marginal rate is tiny. It makes all the sense in the world to pay that low tax rate now, get it over with, and then let that money grow tax-free for 40 or 50 years. That is a no-brainer. If you are young and in a low tax bracket, do Roth.
Okay, simple enough. Group 2.
The expect massive lifestyle inflation group.
I like this group. These are the optimists.
These are people who, for whatever reason, expect to have a much higher income and spend significantly more in retirement than they earn now.
Who fits that profile? That seems unusual.
It is unusual. Maybe someone who is pursuing lean fire, living on, rice and beans now to retire at 35, but they plan to travel the world in luxury later. Or, more commonly, someone who will have a massive pension.
Ah, like a defined benefit pension.
Exactly. If you have a military pension or a union pension that will pay you $100,000 a year in retirement, that pension income fills up all your cheap tax buckets we talked about, the 0%, 10%, 12%, and even part of the 22% bucket.
So your floor is raised, your 401k withdrawals will start at a high marginal tax rate from the very first dollar.
Precisely. In that very specific case where you have other income filling the low brackets, the Roth wins the math.
And the third group?
The super savers and the tax diversifiers. These are the people the research from UBS was talking about.
Right. These are the people who've already maxed out all their pre-tax options.
Yeah. If you put that full $24,500 in the traditional 401k and you've contributed to an IRA and you still have money left over to save, you can't put more in pre-tax, so you have to look for other buckets. A Roth is a great place for that overflow.
And UBS had that specific strategy called tax diversification.
Their advice is, don't bet the farm on one single tax code prediction. Don't go 100% traditional or 100% Roth. Ideally, you want 3 buckets in retirement.
What are the 3 buckets?
You want a taxable bucket, which is your regular brokerage account. You want a tax-deferred bucket, which is your traditional 401k and IRA. And you want a tax-exempt bucket, which is your Roth.
That sounds complicated, but I see the value. It gives you levers to pull in retirement.
It gives you ultimate control. In retirement, you can manipulate your own taxable income. You can pull from the traditional account right up to the top of the 12% bracket to cover your basic living expenses. Then, if you need more money for a new car or a big European trip, you pull the rest from the Roth, tax-free.
So you don't accidentally bump yourself into a higher tax bracket. You effectively cap your own tax rate year after year.
Exactly. You engineer your own tax bill. That is the real power of the Roth for the average high earner. Not as the whole strategy, but as a strategic supplement to a large traditional balance.
UBS also suggested something about strategic conversions. This seemed like a really smart way to get money into a Roth without paying that high price today.
This is my favorite strategy of all. It's for the planners. Instead of contributing to a Roth while you are working in your peak earning years and paying 24% or 32% tax, you contribute to traditional your whole career. You get the tax break now when you need it most.
Right.
Then you wait for a low income year.
It's a low income year, like a sabbatical.
A sabbatical, going back to grad school for a year, or, and this is the most common and powerful one, the gap
The
years.
gap
The
years.
years between when you retire and when you turn on Social Security and your pension. Maybe you retire at 60, but you decide to wait to take Social Security until 70 to get the maximum benefit.
Ah, so for that decade, from 60 to 70.
Your taxable income drops to near zero. You're just living off your cash savings or your brokerage account. You are in the lowest tax brackets of your entire life. That is when you systematically convert your traditional money to Roth.
So you got the deduction at 24% when you were working, and now you're paying the conversion tax at 10% or 12% when you're retired, but not yet taking other income.
Exactly. You captured the spread. That is how you win the game. It requires patience and planning, but it saves you an absolute fortune compared to just blindly checking the Roth box while you are earning your peak salary.
That is clever. That is playing the long game with the tax code. So what does this all mean for our listener right now, sitting here in February 2026? What are the action items?
It means you need to stop autopiloting your 401k. The limits are up. $24,500 is a lot of space. Use it if you can. But look at your catch-up contributions. If you made over $145,000 last year, go check your pay stub. You might be forced into a Roth catch-up whether you like it or not, and you need to know if your plan can even handle it.
And if your company offers that new Roth match.
Be careful. It sounds like free money, but it comes with a tax bill today. Make sure you have the cash on hand to pay the IRS in April. Unless, of course, you're planning to quit your job soon, then maybe take the Roth match to beat the vesting schedule.
Laughs the I'm quitting loophole. I love it. And the big overarching takeaway, for most people, for the 91%, the traditional 401k is still the king of math.
It is. The difference between your marginal rate today and your effective rate tomorrow is a massive arbitrage opportunity you shouldn't give up lightly. Don't let the fear of future tax hikes scare you into paying a guaranteed 24% or 32% premium today.
It is really about running your own numbers, isn't it? Don't just follow the herd or some simple rule of thumb.
The herd is usually wrong. Just remember that 92% versus 9% statistic from Moneyzine. Just because everyone says Roth is better doesn't mean it is better for you.
Here's a final provocative thought to leave you with. We talked about how the government is changing these rules. The mandatory Roth catch-up for high earners, the option for a taxable Roth match. They are clearly creating pathways that encourage, and in some cases, force, Roth contributions.
They are desperate for it. They are shifting the incentives to get paid today. It's all about that current revenue.
So if the government wants you to choose Roth so badly that they are practically forcing your hand, you have to ask yourself a critical question. Is this actually in your best interest, or is it in theirs?
That is the ultimate question, isn't it? Usually in a casino, when the house really wants you to make a specific bet, it is because the odds are in their favor, not yours.
Exactly. They know the long-term math, and the long-term math says they collect more revenue today by pushing you into a Roth than they lose in the future. So look at your pay stub, run the math for yourself, and don't let the IRS's short-term budget needs dictate your long-term retirement strategy.
Couldn't have said it better myself. Be skeptical.
That does it for this deep dive into the 2026 401k landscape. Thanks for listening, and we will catch you on the next one.
Happy saving.